Good morning, everyone. Welcome to Officer 24/7. My name is Niharika Walia Bhatnagar, and I'm with you with the era of ABFM. Okay, today we are starting with Module B. Till now, we are not starting with Module B actually. We are starting with the second last chapter of the Module B. We are almost done with the Module B altogether. Mm, As I told you, the most important chapters were sources of finance, and then comes the chapter that we are dealing with currently, that the capital investment decisions. These were the two important areas to be covered. Next, that comes in this area is related to an important issue: adjustments of risk and uncertainty in capital budgeting decisions. Everybody, let's talk about it. Acha, before I continue with my session, please share the session. Please like this particular session as well. And if you feel that this is useful, then please go ahead and check out the other classes as well. The entire series is prepared for you based upon this particular period only, that we have an entire module to cover, and I wanted to cover it in the best possible way for you. Okay? Acha, now everybody, now we were talking about the portion of adjustment of risk and uncertainty. Acha, everyone, what if when we are preparing the books of accounts, at that point of time, when we are preparing the books of accounts, at that point of time, what happens is that we were deciding about a capital investment decision. While looking forward towards a decision, we need to know about the inflow and outflow. That is only where you can calculate your NPV or for IRR, na, or all those things that we need as per present value, or even if we are using payback period, simple methods. We need to know what would be our inflow over the period of time. So in this case, it is expected variation. We are trying to find out what is the expected cash inflow and cash outflow. Outflow is already defined ki theek hai, if I buy this asset, the cost would be this. Now inflows would be stated there, and then we have variations. How do we define variations? Variations are basically, we thought of a specific inflow, it is going to change. We thought of a specific outflow and it is going to change. When these things happen, our entire model for decision making will turn into a zero. It will turn out to be immaterialistic as well as irrelevant. So, what do? We create a probabilistic set of this is probabilistic set of questions, set of cash inflows. That means most likely cash inflow is this, worst cash inflow would be this, and the best cash flow inflow would be this. So based upon this, you will create three different models with three different answers, and this will determine whether this particular thing is materialistic for us, relevant for us, or correct for us or not. All these things would be taken care of through this. Okay, so when we talk about the capital investment decisions, uncertainties, the uncertainties can make our entire model wrong. It can make our decision making completely wrong, which can create a problem there. So we would want that this problem is solved. That's why we create multiple inflows, and based upon those multiple inflows we can take decisions ki if the worst happens, then it is not beneficial. If the best happens, then there is a possibility, and if it's a mix happening, then what will happen? Mix means of 1 year the worst one is taken, for the second year the best one is taken. So we have to anticipate the future, and we have to anticipate the probabilities of those things as well. Based upon this particular chapter talks about the adjustments that you need to make in your inflows and capital investment decisions due to the variations that can come due to this entire scenario. Okay? What is the distinction between the internal and external risk in risk management? Controllability, cost benefit analysis, then a skill requirement or sources of the risk. The distinction between internal and external risk would be what, everyone? Internal is the risk that the organization is having in itself, while external risks are those risks which you are getting from outside world. You know, that means in this case the main issue would be the source of the risk. internal and external. For example, Ukraine couldn't control the part of the Ukraine-Russia war. It started, I think now it's been more around, this would be the second year that we are entering the war there. This is a source of risk, which is an external risk, not an internal one. It's an external risk which is affecting the market, isn't it? The businesses that were in that have gone, I would say they have been shut down, they have been badly damaged. People have moved out of Ukraine a lot. A lot of people have settled in countries outside Ukraine. Many people are still fighting. What is happening there? There's a risk involved which is external. You know, when the organization is making wrong decisions, you can call them internal risk. That the risk that we can go wrong as well. But when the world goes wrong, what would you do? That is not in your control. Internal things can be in your control. Then, what are the parameters in context of simulation analysis? Actually, everyone, what do you mean by simulation? Simulation is something that uh, to have that reality wali thing now, we create a particular situation which is very similar to the reality. We simulate. That is basically similar to the reality. What are the parameters which exist when we are doing this kind of analysis? Exogenous variables, random events, input variable specified by the decision maker, or variable determined outside the model. What would be the answer in this case, everyone? In this case, when you are doing such kind of models now, then the amounts and everything that has been, it has to be specified. That is, input variables is specified by the decision maker. It is all done by the decision maker. The answer is C. When a business expands internationally, what type of risk may it encounter due to unknown rules, regulations, and market sensitivities? When a business expands internationally, when, for example, Tata went abroad. Tata has been working not only in our country, it is a car which is being sold outside India as well. What type of risk which they encounter? Marketing risk, uh, exchange risk, corporate or seasonal? मतलब see, the point is due to unknown, the rules are known, not known to you. And but even in our India now, one particular thing is there. Uh, Ignorance of law is no excuse. You cannot say we had no idea that India had this kind of rules and regulations. That's one problem. This is one particular reality, even of our country. Then I think we are not exceptional. Many countries would have been following the similar things. Yeah? So this is ignorance of law is no excuse. Then, what is the additional risk that we are facing because of this issue? The second risk that we are facing is the dollars, rupee, yen, pound, all these currencies they keep on fluctuating. You know, the rate of these things doesn't remain the same. Due to fluctuations, can we anticipate that in the future this is the amount of money we'll receive, or maybe we'll not receive? No, no. So in this case, the answer is going to be exchange risk. Okay, the answer is exchange risk. Next, what is the role of exogenous variables in simulation analysis? They are influenced by other variables. Exogenous is external. They are determined outside the model and imposed on it. They are randomly generated by the computer, or they are control variables. Normally, when we talk about exogenous, exo means external. So, what it would be, they are determined outside the model and imposed on it. Basically, exogenous are those variables which happened outside the particular model, and then we are trying to find that particular solution or whatever the things or the points which would come because of the simulation. They are determined outside the model and imposed on it. Next point, sensitivity analysis. Under sensitivity analysis, you need to know about the entire problem that you're looking forward to, the situation for which you are taking decisions. Then you need to know the variables. Then you need to identify the risks involved in it. Then expected inflows have to be stated. The various variables has to be considered. There are so many things that you have to consider when you are trying to have sensitivity analysis. Sensitivity means, acha everyone, if I work in the production area, I work for an organization which is labor intensive. If the price of labor workers goes high, what will happen? If the labor workers are interested in charging more money in terms of their wages, then what will happen? I think the moment this thing is said now, the company is going to be extremely scared. Ki, oh hell, now the people are looking forward towards more wages per hour. How will we afford it? You know, that's one particular reality that they will be scared about their money. But when we talk about the same production organization and we talk about buying a social infrastructure, matlab they wanted to create a canteen, what kind of thing it will have on our decision making? Maybe almost nothing, or maybe the people who are working in the organization, they feel satisfied about it. Sensitivity analysis is basically to the variable that can affect your decision making, that can affect your model. That is what we need to know. We need to identify, if we do not increase the price, if we do not increase the labor earnings, then what will they do? If all the skilled labor are leaving, then there is no meaning to continue the work, because ultimately these kind of people will not be there in the business. So ultimately your business is going to face a lot of problems. ठीक है ना? So in this case, that's the basic thing that will happen. So when we talk about what does step 2 of sensitivity analysis involve, one particular thing that I always state, there would be questions on the basis of processes or on the basis of the steps in a specific process. They can ask you these kind of questions. They can actually create a case study out of it. And then it would be a little troublesome if you do not understand the steps there properly. You know? First is identifying, conducting statistical analysis. Second is identifying project risk. Third is developing mathematical relationship. And fourth is creating financial statements. If we talk about sensitivity analysis, when we talk about sensitivity analysis specifically, it is to develop the mathematical relationships, because if we want to study the various variables, we need to know about the variables properly. That is developing mathematical relationships. Why is it important to understand the connections between different variables and sensitivity analysis? We need to know how many variables are connected to each other and how is it affecting the decision making as well. To complicate the analysis, to create confusion, to improve project communication, or to assess the impact on NPV or IRR. What would it be? Why is it important to understand the connections between different variables in sensitivity analysis? We need to have it when we're trying to find the NPV or IRR. When we're trying to find the net present value, this is a net present value, na everyone. Whenever we are trying to find the net present value of something, or we are trying to find the internal rate of return, at that point of time we need to know, acha, what are the variables. Matlab, this is one of the basic questions which should hit your mind ki, ma'am, what are the variables? If I am looking forward to it, initial investment, the time tenure for the particular area, then we talk about the discounting factor. Any of these things, if any of these things is changing, then the entire working will also change, right? So how much will it impact if the initial investment increases or decreases, or cash flows per year, the per annum increases or decreases, or if there's any variation, it will impact your ultimate decision making. That means it will impact your amount for NPV, that is net present value, or the value of internal rate of return. So in this case, the correct answer is to assess the impact of on NPV or IRR. What is the alternative measure besides NPV that sensitivity analysis may focus on? Project risk ratio, internal rate of return, projected payback period, or project cost index. Other than NPV, everyone, what is the other method that can be used? वैसे ना पता है IRR is NPV and IRR are siblings. Both these methods use present value. Present value of inflows. Though cost project Cost index, nahi, this is not the one that uses it. Project risk ratio, nahi, none of them is actually related to this area. Payback period is also an organization when uses project payback period, they are not utilizing the present value. Time value of money is not being considered. So the answer, even though you might be looking forward to it, but I believe that would go wrong, because you need to consider the fact that due to inflation, due to the falling the value of money, the value of the money is falling even. You know, for example, at one point of time, I think, um, with around 15 rupees, or I think I remember I used to buy a bottle of 500 ml of Coke for 10 rupees, and then it went up to 12 rupees, then it went up to 15 rupees, and straight after years, and when I went to buy it again, because for a good amount of time you just don't buy all these things at all, so I realized the value of it currently is 30 rupees. So what is it? The value of things are increasing now. If you do not consider the time value of money, how will we find out whether the decision making is going correct or incorrect in long term, not in short term? The answer is related to the area of internal rate of return. How does Hillier quantify the risk associated with cash inflows in this model? Hillier gave a particular model which is actually called this is the name of the person who originated it. Through the payback period, he's talking about cash inflows by analyzing market trends or using standard deviation of cash inflows or assessing the project stakeholders. When we talk about Hillier now, his model had he had been using standard deviation and cash inflows. What we thought and what we are exactly having, the deviation from the mean is considered in this area. That is, they consider the standard deviation. Which university is associated with Professor Frederick S. Hillier, the proponent of Hillier model? The Harvard University, MIT, Massachusetts Institute of Technology, Stanford, or Oxford, everyone? So this is a pure theory question kind of thing, but they can actually come up with the name or the philosopher that we are supposed to know that this was the person behind this particular thing, that he was the one who initiated or he gave this particular idea. So he was from Stanford University, everyone. He was from Stanford University. Okay, now let's move on and look at the next question. In the Hillier model, what is the significance of two cases? No correlation among cash flows and perfect correlation among the cash flows. To complicate the analysis, to simplify the model, to assess market trends, or to understand the impact of correlation on risk. In Hillier's model, what is the significance of considering two cases? When you consider two cases, then you can actually understand the impact of correlation on risk, because you correlate different variables, and then you can find out which variable turned out to be useful for the organization or which was not useful for the organization, because that clarity is definitely required, you know. Then next point, what is the primary purpose of simulation analysis in decision making, everyone? Creating artificial situations, or imitating real scenarios, or identifying sensitivity in the project area, or deceptive analysis? This cannot be deceptive analysis. The term deceptive is a little negative to use. So what would be it, everyone? It is going to be identifying sensitivity in the project area. Whatever creates sensitivity in the particular scenario, we are going to try to find those things which can increase or decrease the particular working. This is very similar to the real scenarios, but in this case we have multiple variables which are working to test that area. So this is identifying sensitivity in the project area. Chaliye, now that's it for the day, everyone. But before I end my session, I hope you have reviewed our courses. If you haven't, then please go ahead and check out our courses all you need to do is go onto the area of our website, that is www.adda247.com. Go onto the area of JIB and CIB, and here it is June 2024 Shapat batch as well as resolution batch. Both the batches are here. This batch is for English medium. We have 4 subjects there. But the optional is not available in this. If you want to take up optional, then you should take up the Mahapack. Use the code Y541 and you will get it for 5519.77. 78% discount can be availed if you are using our app. So first of all, download the app and utilize this particular um, point where you can utilize your coins to get further discount. So please check it out on our website and our app for further details, everyone. Other than the resolution batch, we have a Mahapack which includes all the specific books, articles, ebooks. We have got ebooks, we have got test series, we have got regular classes, we have got PDFs of those classes, as well as you get practice paper as well to prepare properly. So if you're looking forward to it, then check it out on the website, the term Mahapack. You can check out the Mahapack. All you need to do is go back. See, this is Mahapack 2.0. Click on the area of Mahapack 2.0. Use the code Y541 and apply it, and you will get for 7473.85. So this is our the courses that you can purchase. So check it out on our website and our app for further details, everyone. Thank you so much, and